Okay, so we're ready to start the webinar. Thank you very much again, everyone, for attending. I'm assuming everyone's had a chance to read the risk warning at this stage. I'm going to skip through to the next slide here, and that gives us the title for today's presentation, which is How to Trade the Euro-US Dollar, or Euro-Dollar, or the Euro, or umpteen names that you tend to give it when you're trading. You'll notice that in this webinar, we draw it without a slash in the middle of the euro and the US dollar. That's just because how it's shown in the LCG trader platform. You can also draw it with that forward slash in the middle too to separate the two currencies. Side point there. Not even sure why I mentioned it, but just in case you're wondering, it is the same thing. So how to trade the euro dollar. Topics covered for today. We're just going to talk a little bit about the euro dollar, what it is, where it comes from, etc. What causes the euro dollar price to change? Now, just generally understanding the general concept of, I suppose, what moves currencies in general, but more specifically what moves this particular important pair. The top economic data releases to watch when you're trading currencies, because from a fundamental perspective, those data releases tend to drive the action day to day. Just particular note when trading the euro that kind of separates it from other currencies, if you like. Obviously, any country can default, and that would cause like big problems for its currency. You only have to look over at Venezuela at the time of recording this webinar, and likely whenever the future. It's hard to see Venezuela stabilizing anytime soon. Their currency suffers. But what's particularly interesting about the Eurozone is that it's obviously made up of multiple countries, which is a bit unique. And then we'll just talk briefly about some of the technical indicators that you can follow for the Euro towards the end, and we'll have a look at the Euro on the LCG trader platform. Any questions at any point, please feel free to fire them through. I'll do my best to answer, either as you ask them or towards the end of the webinar. Yeah, and obviously if anything's not clear, just let me know. Same goes if you're watching this afterwards on YouTube or social media, just post a comment and we'll get back to you. So about the euro-dollar pair, what is it? Well, we've already kind of explained it through the name, but obviously EUR is the currency symbol for the euro, USD is the currency symbol for the dollar. The euro, what makes this interesting is that obviously the euro and the US dollar are the currencies of the two largest economic trading blocks. We haven't written country because the Eurozone isn't a country, it's a trading bloc. It's not even a continent. Europe is obviously the continent. It's not even a political union. It's that would be the EU. It's the Eurozone, which is not every country inside Europe is not part of the Eurozone. So there is a slight distinction there. There are 27 and ever expanding numbers of countries in the EU. But there's only 17 as it stands in the Eurozone. But because there's obviously most of the world's economic activity is happening using these two currencies, it obviously means there's a lot of transactions taking place. So that makes it the most traded and by its nature the most liquid currency pair. Liquid meaning how easy it is to buy and sell at the price you would like. So obviously, when I say the price you like, I don't mean just a price that's unavailable in the market, but you see the current market price of this quoted for the euro. How easy is it to get your trade done at that price? And with the euro dollar, I'd argue that it's probably the easiest of any financial instrument out there. And what's also good about that, as a side note, is it makes the spread, i.e. your cost of transaction, very small when it comes to trading the euro. And that can be a very good thing, especially when you're first trading, because you don't want to be clobbered by giant spreads, even if it exposes you to perhaps bigger price moves in more exotic currency pairs. Almost better to kind of have a little bit more control on your initial transaction with lower spreads, even if it means maybe slightly less volatile movement. And because there obviously are so many sellers, it sort of moderates the reaction somewhat. So you could argue, obviously it has big volatile days, but all those buyers and sellers put together are almost like a greater level of intelligence than if it's just a few people backing and forth. That can make the price movement more erratic, you could say. So why is it so important? We've kind of already alluded to this, but it's corporations with business in the US and Europe. They, maybe buying in Europe, selling in the US, vice versa. All sorts of operations which interact with each other, even just part of their own supply chain. Buying this part in the US, having it reconfigured somehow in Europe, then back into the US. So there's all sorts of exchange risk when these products and services are flying back and forth between these continents, between these big companies. And so they've got to do their best to hedge that risk. When they're planning an investment and they're saying, well, if we sell this many units in Germany and we buy them in Alabama, we've got to make sure that investment still makes sense in 6 months' time, that the exchange rate hasn't moved so much that suddenly the whole thing's not worthwhile anymore. So that's the whole idea of hedging. And largely because of all these corporations and to a lesser extent individuals and certainly governments as well and central banks doing all these transactions, it means that there's room for financial institutions. So there are intermediaries. So that's typically the sort of supply side of the market, if you like the big banks. And there are also outright speculators, which we'll talk about a bit more later, which are the buy-side institutions. Now, on the more flamboyant side, you have the hedge funds. The prices on the slightly more stable side, you have the pension funds. So obviously this is a big question that we all really want answering. It's good to, I've started with those other two slides because I always just say it's good to know what you're trading. A lot of the time when it comes to trading, well, it's just a price. It could be anything you're trading, but I do feel it's good to have a bit of background knowledge to it and to put the whole thing in a bit of context. But ultimately, what causes the price to change? That's what we really want to know. Back to the same idea of speculators and hedgers. So firstly, speculation. The aim is to maximize profits by taking advantage of unsustainable currency prices. So the logic being currencies, the currencies that we trade are open and free floating currencies, i.e. no one's outright at least trying to manipulate the price or trying to fix against another currency. So they're free to move against each other. The value of a currency is free to move against another currency. So free floating exchange rates. And it can get to a point either on a very short-term basis or on a longer-term basis that exchange rate is unsustainable based on the economic direction or political direction of those two economies, of those currencies. And so you have an opportunity to buy in low and sell high, obviously, and vice versa. Hedging is slightly different. It's more what we were talking about before. The aim is to minimize business risk. So it's less about the exact price and whether that particular price is offering value versus its historical price range and considering global economics. It's more about, well, we need to hedge the risk we're going to be exposed to in this particular business operation that we're exposed to at the moment as a company on a kind of micro basis, rather than so for that reason it's more about where does the exchange rate move over the next 6 months. Are there some big chances of big movement? If we make the guess, some companies who are very sophisticated will actually make their own assessment. Well, actually, we think the currency is going to be pretty stable over the next 6 months. Maybe we don't need to hedge much, or we don't need to fully hedge our positions or our exposure through this transaction that we're doing. Or they may decide, oh, well, there is all sorts of political risk, loads of elections, goodness knows what can happen. We better hedge this whole transaction. So they are considering the environment, but only in the context of their particular deal with their particular time frame. But I would say that both speculators and hedgers are asking the two, obviously it breaks down into much more sophisticated levels than this, but on a basic level, they're asking two questions, and they answer them in pretty much the same way. One is, are European interest rates going to go up or down more than in the United States? That's the first question. Second question, is Europe becoming a better or worse place to invest versus the United States? Obviously, if Europe's becoming a better place to invest, you need some euros to be able to invest in Europe, right? No one in Europe's going to take dollars for the most part. Or, if you're in Europe and you're thinking the US is doing really great right now, no one in the US is going to take euros. You're going to have to convert your euros. You're going to have to sell your euros into dollars. And that kind of favorability of the investing environment obviously affects the value of the currency. The first question there is something that's a bit more understandable and a bit more quantifiable, is in terms of interest rates. And obviously, you generally want to be placing your money and holding your money in a currency that's going to be earning you more interest, right, than a currency that's not earning you interest. So for a long time, European government bonds earned negative money, actually had negative yields on them. That makes it less attractive to hold euros, and naturally that would cause the value of the euro to drop. If indeed and obviously remembering it's all relative, Europe versus the US. So how do you answer these questions? Well, we talked about it a bit already, but are the economic and political developments in European countries making it A, more likely interest rates will change more than in the US, and or they're more likely or more or less favorable for investment in the US? So it's all about those economic and political developments, and how are they changing the picture, interest rates or the investing environment? So moving on to specifically talking about economic releases now, because this is something that you can really kind of tap into, and it's quite easy to understand versus there's lots of kind of slightly strange esoteric concepts almost when you start trading forex. But economic release is quite a solid thing that you can look at and rely on coming out each month. So where to focus? Because the Eurozone has, as I mentioned, 70 members, which means a lot of data coming out. So lots of data from the Eurozone can be ignored from a trading standpoint because it would just be too much to deal with. 17 countries releasing all sorts of economic data, from consumer confidence to, so not all of that is necessary to follow, because, there's only so many things that really, what I'm trying to say here under this main idea, actually affect investor confidence. How frequently can your overall sense of confidence change? Not that frequently, right? If you're feeling very confident in the state of European politics, but then, some report from Slovakia comes out and says that, economic growth for the next quarter might drop by a point. Okay, important for Slovakia, obviously, but not so much for the overall feeling of investor confidence towards Europe, and unlikely to affect the euro. So going back to that same idea again, two reasons for holding euros: to earn interest rates and to have European investments and assets. So with that in mind, let's just, you probably had a already. On the right-hand side here, we've got the most important data for the euro-US dollar. And it's kind of the same stuff, number one in the Eurozone and number two in the United States. You could say actually number one, it would be the United States, because the dollar is the world reserve currency. That's pretty much the most important currency in the world. But this presentation a little bit more geared towards the Eurozone, because obviously if you're trading pound dollar, dollar yen, dollar Swiss, if you're talking about the dollar data releases all the time, then you're kind of repeating yourself. Nonetheless, if the ECB is the European Central Bank, so the Central Bank of Europe, their monetary policy meeting is right up there in terms of the most important, because they are setting interest rates, and the interest rates that they set are the benchmark rates, where they filter through the markets to bond markets and money markets, etc. So there is a central bank controlling the rate of interest for that currency. So obviously important if they do that. If they raise rates and signal they're going to again in the future, that should be positive for the euro. If they cut rates or signal that they're going to be cutting more in the future, tends to be negative for the euro. And if they and so equally, the meeting is important, but often what they'll do is try and signal to the meeting so that there isn't any big shocks when the decision takes place. They'll obviously try and sort of guide the market, if you like. There's this big term now, forward guidance, which hasn't worked particularly well because they're always sort of chopping and changing their minds according to market reactions and et cetera, et cetera. But when ECB members talk, particularly the Euro ECB president or the vice president, it's worth paying attention to because they may be trying to signal something to the markets about their future policy. Now, inflation is the other big one, because particularly when it comes to the central bank, their only actual, their only objective, official objective, is to keep price stability. When you're talking about prices, you're basically talking about how much prices change over time. That is inflation or deflation. So if prices are going up, it's inflation; down, it's deflation. They're trying to maintain. They have a target at the time of this webinar, and I doubt it's going to change anytime soon, of 2% inflation. So if the current level of inflation, when you see this data release for Eurozone CPI, comes in at 1% year over year, and their aim is to have 2%, well, then they're probably not going to be raising interest rates anytime soon, because normally what happens is when you raise interest rates, that tends to reduce inflation. If you see data coming out saying inflation is 3%, aim is 2%, well, then maybe they are going to start raising rates because they need to actually tackle that inflation. Not always as simple as that, unfortunately, but that's the general idea. GDP, now Eurozone and Germany being the biggest economy, so that's why we tend to focus on German data, because it's the biggest economy within Europe. A lot of the kind of euro-dollar trading has its historical basis in Deutschmark trading, so a bit of kind of legacy there. And so obviously the health of the economy, if the economy is improving, it's going to make business conditions better, right? And probably at some point in the future, it's going to mean that maybe the economy even overheats and would require raising interest rates, which would be better to hold your currency in a raising rates environment, right? And it's the opposite for the United States, or the opposite or the same, if you like. The FOMC meeting, that's the Federal Reserve's meeting on monetary policy. Whenever Fed members make comments, particularly the chair of the Fed, it's worth noting. US CPI is consumer price inflation, US GDP, gross domestic product, and ISM is the firm that typically, or for a long time at least, has released manufacturing and services PMIs, which I didn't mention for the Eurozone, so I skipped that bit. Same idea with both. These come out, there's various revisions throughout the month, and I suggest checking the LCG economic calendar. But the idea is that these are quite forward-looking, so they're based on surveys of purchasing managers. So what's good about them is that oftentimes by the time you get the GDP data, for example, that's already happened. The markets are obviously pricing in what's going to happen in the future. So while you're looking in the rearview mirror, you actually want to be looking out at the windscreen and seeing what's ahead of you. So PMIs are people giving their opinion based on what they're seeing in their business about how their orders are going to grow, and obviously, more orders for businesses generally shows the expanding economic activity, which again we said is good for that respective currency. So that's the, I mean, that's the most important stuff for the in terms of economic data releases. So I wanted to move on to this idea of the Eurozone breakup risk. Excuse me, I had to mute it there for a second. I had a frog in my throat. Hope you didn't hear me coughing away there. Hopefully that mute button worked. So back to that same idea. So there are 17 members of the Eurozone, so it presents a fairly unique situation. Obviously, there are various states within the United States. You could say that's somewhat similar. If one of the states in the US went bankrupt, which in the middle of the financial crisis, there were a few on the brink, but didn't quite happen in the end. Even local governments are actually able to issue bonds. We still need people to buy them, and if there's no confidence, they won't, and then they won't be able to fund their own operations. So, general idea being that okay, so I've gone off on a bit of a tangent talking about the US, but when you talk about most countries, obviously, even China, talking about the yuan, talking about Canada, you're talking about Mexico, the peso, talking about to the UK with the British pound. Okay, there are some different countries within there, but as a whole, it's one economy. What's different, obviously, is this is a cluster of very different countries with economic growth at different stages of development, different swings in the economic cycle. And the massive argument against never having the euro in the first place is that all these economies are so different and at different stages of development. Some are, expanding while others are in, borderline recession. How do you set monetary policy for all those put together? That's the ultimate argument against it. So far, it's held together. So, that argument hasn't really stacked up. The time will tell if it eventually does. Maybe if the euro is in existence long enough, economies become a bit more harmonious, a bit more homogenous, particularly if fiscal policy is going to be set as a group. At the time of this webinar, there's a lot of talk of it. It hasn't happened yet. In essence, making Europe one big country with all the same policy being set. Even then, it's difficult to see how the growth in different areas can become parallel. So, difficulty of the euro's existence, is the point I'm sort of getting at here, is that if one of those members really gets into trouble, and the last time we experienced this really was in a big way, was the eurozone debt crisis, and at the heart of that was Greece. If Greece go default on all their loans from the IMF and the eurozone, in fact, and they actually leave the euros, then it destabilizes the euro because one of its members has suddenly left. Obviously, the growth of that bloc has fallen because there's one less member. The business environments become slightly less favourable. When it's a difficult environment politically or indeed economically, then it's going to be difficult to raise interest rates in that environment. That's just a short-term effect, but ultimately, the effect might be a domino effect where other countries feel they have to leave either for safety reasons or because they no longer believe in the whole project of the euro, and so eventually the euro just collapses. Now, I'm not saying this is going to happen. I acknowledge the possibility of that happening. Some people don't think it's possible. I believe it certainly is possible. But the idea is when there are times of crisis, this issue starts getting brought up. So at the time of this webinar, the major but when there were a series of European elections being held and populist parties were touting the idea of leaving the Eurozone, particularly in large countries like France, then that was a genuine risk to the actual existence of the euro. So they were calling it an existential risk to the euro. some of these political events, and the euro lost value because of that. So it's not a sort of day-to-day factor, but it's a reason to pay particular attention to certain things happening within Europe. So these, switching gears completely now, just to the technicals. The thing is with the way I would describe one market from the other, and this is not just specific to euro dollar, but also other currency pairs and other financial markets, they all have their own slight characteristics. But I don't know if I could go so far as to say one indicator is better than another for a certain market. So I think these general rules that for trending conditions, there are certain indicators that work well. For range-bound conditions, there are certain indicators that work well. But I think I'd struggle to say that one indicator works better, quote unquote, in one currency pair than the other, or one market than the other. What I would say is that they certainly have historical kind of characteristics, and it takes trading a market for a little while to kind of appreciate how it moves. On a very kind of simplistic level, maybe one currency pair tends to consolidate in very tight ranges, and then will suddenly break out into a very sharp trend, and then we'll just consolidate again. Another currency has tendency to kind of have long waves up and then kind of deeper retracements, and then long waves up and then deeper retracements, and then a trend reversal. And so others, for example, I would say the euro tends to be one of the more orderly markets, which I think makes it quite good for a combination of trend trading and pullback trading. I would say the pound in general, so sterling or cable, tends to be a little bit more volatile than the euro. So you'll get bigger moves in terms of number of pips, but that's partly because of the price, but also bigger retracements in a percentage basis from the initial move in the pound. And you'll get price moves that kind of suddenly fire away with minimal retracement more often in the pound. So it's hard to explain this without really kind of showing it in charts and feeling it in charts. But one thing I would just say is that I don't think one indicator works better in a certain market, but markets certainly have a certain characteristic, more in terms of their sort of volatility, if you like, or their kind of general flow of the price action. And working out which indicators can capture that in a certain market best, that's generally a personal preference. But these 5 on each are generally a good benchmark. You'll notice that I've got MACD and RSI in both. That's why I tend to like those two indicators, because they do fulfill both objectives. You don't use them in just the same way for both. But the way that those indicators are constructed, you can interpret them in, you can use certain characteristics of them for range-bound environments like overbought, oversold, and then you can use other ideas in terms of levels and divergence and things for in a trending environment. But we go massively into the technicals on this particular webinar. That's really for other webinars. And then just quickly, I'm going to jump over to the LCG Trader platform, just so we can sort of see the euro in action here. So you can see along the is the website where you find the LCG Trader. For those who aren't familiar, these are the tabs of the different markets you can trade. So obviously you've got gold, Facebook shares, Wall Street, Brent crude. But over here we've got the euro, and you can see this is the candlestick chart for the euro. And then this over here under our watch list is where we have some of the most popular markets to trade. Here you can see the euro dollar, so you can kind of expand it. Here you can see that as of the moment the market is indeed open for trading. Buy and sell, obviously we're getting a bit of a dip down here. Maybe this is the end of a pullback. Go for a buy, click in for a buy order, and you can see that I've just clicked in a few orders on the right here. If I want to watch where those orders are, I just need to bring up my my screen here. And for the moment, we've had a little lucky bounce, and we're getting some small short-term profit, but I'm not sure that'll necessarily last in the short term, at least. If you want to not distract yourself, you can change the view. I'll put it into full screen there, and I've changed it out to full screen again. What am I doing? Oh, there you go. Get rid of watch lists, have just the chart on the screen. And then if we wanted to have a look at some more information on the euro, this is where you can really get a full feeling as to how it's traded on the LCG trader platform. Obviously, it's quoted in dollars, so the profit you make is up and down in dollars if you're talking CFDs. You can trade that fraction of a pip, a tenth of a pip. The typical lot size we've been trading the euro dollar is 100,000 euros. So that's hence the need for typically for some leverage in the account, because unless you want to throw 100,000 euros around, you need to trade either smaller increments of that. So you can see that the minimum trade size is just 1,000 euros, or indeed you can trade 100,000, but you need to use margin. And down the bottom, you can see that the amount of leverage is available according to the size of your trade. Those leverage amounts obviously are changeable over time according to company business decisions and regulation. You can see the market hours here, pretty much 24 hours a day. Obviously, it starts pretty much on Sunday, and then it finishes Friday evening. And these times are based on GMT, I believe. So it's going to vary slightly according to what part of the world you're in. And then there's just more details here in terms of the availability of guaranteed stops, and for example, one thing to note is if you're going short the market right now, you're going to earn some money. If you're going long the market, you're going to lose a bit of money if you hold that trade for overnight, so past 10 p.m. GMT. That's the nature of the beast in currency markets. So have a look out for swap rates. Speak to your account manager if you want to understand it better, or talk about the prices. And then the spread, last but not least, is going here. It's easy enough to see, and you can see it's variable according to the market conditions. It jumps around a bit, but it's generally pretty healthily below 1 pip. So just that fourth decimal place there is just 1 pip. So it's a fair fairly small amount. You need to recover that 1 pip first, and then you're or that less than 1 pip, and then you're in the profits. Right, so I think we'll call it a day there. Just had a hello from Gillies. So yeah, thanks for that. Yeah, good to see you again. But I think as far as questions we're done, and probably as far as the particular webinar we're about done here. So for anyone who's watching the football tonight, enjoy that. Otherwise, I'm just going to skip through to the end of this webinar presentation and just sort of say, thank you very much for attending. All right, cheers everyone. Have a good afternoon and good week trading. It's Jasper signing out.